Joining us right now is Pacer ETF Distributors President Sean O'Hara, and it is good to see you, Sean. Thanks so much for joining us.
Good morning. Thanks
for having me.
Before
we go into some of the flows and what you're seeing in terms of ETFs, how would you characterize the earnings season? Give us your take on the backdrop so far.
I think the backdrop is sort of like what we talked about last time I was here, which is you're starting to see a little bit of a slowing in terms of the earnings. So we got a little bit spoiled perhaps in 2018 with such, meteoric, if you will, earnings growth, 20, 25, 26, 28%. And now we're getting into a phase in the market where it's just not sustainable to continue to do that. So I think we're adjusting to what's going on with regard to earnings more than anything.
I wonder maybe if expectations have been set too low. We've been sort of discussing whether the U.S. can hit 3% growth again this year. What does it mean if we are growing at 3%? Are these stocks cheap at this point?
Well, I don't know that stocks are necessarily cheap. If we get to 3 or 3.5 or 4%, then I think they're cheap. But I think that's the big wild card. Are we going to get that kind of economic growth, particularly since we don't really know yet what the effect on the economy is going to be of the shutdown? I mean, this was not a normal shutdown. This was not like 3 or 4 days until they argued and then somebody gave in. This was over a month. And so there's going to be some effect. I just don't think we know exactly what it is yet.
What did you think about the Federal Reserve yesterday? On hold at this point, even talking, as we expected, Dagan, about the balance sheet possibly pulling back on the unwind as well.
Yeah, I mean, there's generally been three headwinds, if you will, for the market. One was what's the Fed going to do? One was trade in China, and then the third is this slowing earnings thing that we talked about. What I saw yesterday and what I think I heard yesterday, everybody sort of hears their own interpretation of what's going on. But what I heard is that the Fed is going to be more accommodative than they have been as far as their posture is going forward. I don't know if that's a reaction to the stock market. I don't know if that's a reaction to something they see with regard to earnings or the economy. But I think one of those headwinds was essentially removed yesterday from what people's expectations are going forward.
I will raise this issue. Clearly, investors loved what they heard from the Federal Reserve, but it was a complete about-face from what they said 6 weeks ago. And at some point, do investors start wringing their hands about the economy, about economic growth around the globe, and even here at home? We've seen weak growth in France and Germany. That's a story in the Wall Street Journal today. Will you have a different reaction in the days ahead when people really digest, whoa, what does Jay Powell and the Federal Reserve see in the months and the year to come in the U.S. economy?
I mean, of the three things we talked about, Fed, trade in China, and earnings, clearly to me, the earnings piece of it's the most important part. That's what drives stock prices from a fundamental perspective, is what are they making in terms of earnings and free cash flow. So I think that's the big one. But I think if you're a little bit of a skeptic and you want to be a little bit more intellectually curious, if you will, I think what you would do is you would do what you're doing, Dagan, is say, wonder what they know that they're not telling us yet, because they really have made a pretty remarkable change.
Well, I would say in the last couple of weeks, I think it became clear that we were seeing real issues in Europe and China. I mean, whether it be France, the budget issues in Italy, Brexit, and the uncertainty in the UK. So we knew going into the Fed meeting that Europe was slowing and China growth has slowed. And in fact, I think it was becoming more and more well known that the Federal Reserve had pivoted.
Yes.
So, I mean, you said you were stunned in the commercial break. I wasn't stunned by yesterday's. I mean, I wasn't stunned at all, actually. I was expecting the Federal Reserve to tell us they were on hold.
Well, I don't think they said they were. What I said I was stunned. What I was stunned by was how aggressive I feel like Powell was in his positioning, saying that we will use anything we have, including the balance sheet.
Yeah.
So that was the new one. It's always been about rates up until now. The balance sheet came into question.
What Dagan's saying is the backdrop, what the Fed is recognizing is what we were starting to understand better, and that is we're talking about a slowdown. We're looking at a slowdown, and that is. We don't live in a vacuum. Of course, the U.S. is going to get impacted.
You know why you weren't surprised? Because of your interview with Ray Dalio and your ongoing interviews with Ray Dalio and what he said. What did he say last week? That the Federal Reserve is not going to raise this year and could cut.
Right.
Or do something with the balance sheet to be more accommodative. That's what they said. But I don't think that the rest of the market has quite digested that. They need to go back and watch your Ray Dalio interview.
Yeah, and all the interviews in Davos last week, it was pretty much unanimous that we're facing a U.S. slowdown. What wasn't unanimous was how steep it might be. Look, GE and debt, the company's debt is now over $100 billion. The Journal is reporting if GE were to sell its jet leasing business, it could eliminate up to $40 billion in corporate debt. GE Capital owns and leases thousands of planes and helicopters to carriers around the world. The stock is up 2.25%. I don't know. The earnings miss, but I guess people like the fact that the revenue is better.
Well, and this is
low expectations for this company
That too.
and stocks generally. And by the way, I'm not sure the Fed has changed all that much. What we're seeing is this is the Jay Powell strategy of we're not going to get locked into a long-term plan. We're going to watch the data. As you said, the market signals lately have been bad. Inflation lately signals that it's mild.
Yeah.
I'm not sure.
At the end of the fourth quarter, they were on autopilot. They were like $50 billion a month. 3 rate hikes, right? So that was where the pivot is that I'm referring to.
Right. But I don't think it means we're not getting rate hikes this year. If the economy grows faster than the consensus, and I happen to think it probably will, then you could see some rate hikes. But they're saying we're watching the data.
Rate hike.
They might not hike at all. Like Ray Dalio said, they might end up cutting because from the last hike to the first cut, it's usually a 6-month period. Granted, they need to slow down the balance sheet reduction before they do that. One thing I want to note, to connect the GE, the level of debt there, and what the Federal Reserve did, that's why the market was freaking out when the Fed was continuing to move a quarter point every 3 months. Because of the level of indebtedness of corporations, the level of indebtedness of the United States and individuals in this country. We are a nation that can't handle even 3% short-term rates, and that should be frightening to people.
Yeah, and you've said that a lot, actually. Sean O'Hara, great to see you.
Thank you so much.
Thank you so much for joining us. We didn't even mention your INDS, which Kevin Kelly wanted us to. Up 14% year to date. You're seeing money flows into some cool ETFs.
We are.
Thank you, Sean.
Thank you.